Hello, everyone. Welcome to our second quarter investment commentary. I am George Padula, Chief Investment Officer for Modera Wealth, joined by my colleague, Sarah DerGarabedian, who is Director of Investments and Research here at Modera. And we're really excited to bring you this commentary today. And we've had a lot of questions from clients coming in. And we wanted to do three things here that we'll talk about. But before I do that, I've got a little bit of housekeeping. We are recording this, so we will be able to send out the recording and the slides afterwards. Once we have everything done, that'll take about a week or so. And then I know that there is an opportunity to ask questions in the chat as we go through this, and we will look through them to see if we can add anything to those questions and answers. But certainly, if we are not able to get to your questions along the way, we will get back to you on those. So with that, why don't we kick off? And we're joined by a couple of our colleagues to help us guide us along here. So there's our pictures. And our next slide, I think, here is really what we're going to talk about. A little bit on kind of what happened, looking in the rearview mirror, talk a little bit about kind of what the current investment landscape looks like. There's a lot of questions about tariffs, what's happening with interest rates, what are we thinking about the dollar? And so I think we'll address those. Those are some of the major themes. And then wrapping it up with kind of how we think about it within our portfolio positioning. For those of you who are new to the webinar, I want to just kind of identify who we have in our team, because our investment team here kind of put it out into two different groups. Our portfolio management and trading team, they're the folks that are rebalancing, helping the advisors work with client portfolios. And then the team and that's Jesse Goodwin, who heads up that. And then Sarah heads up our investment team in terms of research and due diligence. And bringing this together, we want to have really high quality, sophisticated investment approach for you, giving you our best thinking on how we impact your portfolios, impact your financial planning, provide you with good economic and market perspectives. That includes our quarterly commentaries, our investment briefs that are coming out, these webinars, and we really take a forward-thinking approach, but very deliberate, very evidence-based approach in how we look at things across portfolios for you, our clients. So wanted to give you that perspective on who our team is. We've got a fantastic team that works really, really hard on your behalf. So, next slide, please. And the next slide. So what happened? So Sarah, how's this quarter going for us, right? You just got back from some vacation time, and quite a difference from first quarter when we last had this conversation.
Yes, George, thank you. It looks quite a bit different. So the last webinar we had was in May. So April had already come and gone, and we covered a little bit of that activity in our last webinar. But of course, April is part of the second quarter, which is hard to believe at this point. So if you remember, April was a very volatile month, but look where we ended up at the end of the second quarter with U.S. Market up of almost 11%, which is higher than the long-term historical average of about 10. And then, of course, we have international and emerging are still doing really, really well, both around 12% for the quarter. Real estate is up. The bond market is up, both globally and in the US. So it's green across the board, which is very surprising. If someone had told you that at the beginning of the quarter, you might not have believed that it would end up that way. And you can see on the bottom half of the screen how much better we are doing than the average quarterly return since January of 2001. Just low single digits there, and we are in the double digits almost across the board.
It is actually incredible, Sarah. And one of the themes that we talk about a lot is time, allowing portfolios to have time, taking a long-term perspective, the time for compounding. And I think the next slide really kind of illustrates this, that the short term can be really volatile. But when we think about kind of the longer term, I mean, when we look and there's some index numbers here and showing the year to date and 1 year and 5 years, maybe if you could just kind of expand on that second quarter to talk about what we're looking at here in terms of year to date and 1 year. And I also think that the 5 year column is really fascinating.
Right. So if, again, starting with the equities, if we look towards the middle of the screen, you can see the S&P 500 is up 6% year to date. So we had started in the negative. So I don't know if you remember, but our first quarter review, the US stock market ended the first quarter down about 4.7%. And developed international and emerging were both up, but only in the single digits. And just like another 3 months makes a huge difference. And you see where we are year to date on both of those. And the bond markets as well, looking really, really good. And like you said, if you expand over to the right-hand side, if we're looking at the 5 year returns, and George, you made a good point. We were discussing this a little while ago. Where were we 5 years ago? Do you remember? It was the summer of 2020 in the height of pandemic lockdown. And here we are now. I mean, what do you think?
It's amazing. I mean, if you thought 5 years ago, right, that here we were, where would the markets be? Where would the economy be 5 years from 2020? No one really knew. We were still trying to figure it out. And I think when you look at this, it's absolutely remarkable. The quantitative easing, the drop almost to zero in interest rates really boosted equities and most bond markets across the board. It's remarkable to think that the S&P 500 over the last 5 years has averaged nearly 17%. But at the same time, if you look at emerging markets and international markets, up 12%, 7%, the equal weight index, not accounting for the Mag 7 and such, up 14. So I think it's remarkable, not so much that we had this huge run up in large cap stocks, but we had such a run up across the board. And even when you get into the small cap, the Russell 2000 value up 12.5%, well above long-term averages, 18% for large growth and 7%. It really tells you have to give markets time, you have to be disciplined, you have to have that global approach and that diversified approach. And the short term is going to be up and down. We know that. Long term, that evidence base really should work itself out. There's no question. So, and I think the next one here, you talk about at the beginning of the year, right? We were down a lot. And this slide here talks about the ups and downs for the first part of 2025. You want to talk a little bit about this one, Sarah?
Absolutely. This is a great visual to show you the max drawdowns for year to date in red. So again, if you look kind of 4 rows over or columns, I should say, you see US large cap where, the end of the second quarter, we're up 6.2%. We were down almost 19% at one point this year. I think that was probably in April. And look at for many of the other sectors of the market as well. I mean, the broad dispersion of the highs and the lows. Just think about what kind of damage you could do if you had liquidated at those lows without waiting for the markets to normalize and hit the returns that they're at now.
And if you remember, for the audience, at the beginning of the presentation here, I talked about our portfolio management team. We were actively rebalancing. So when markets go down, valuations go down, we want to be a buyer. When markets are going up, we're paring back. So we were actively rebalancing, whether it was tax loss harvesting, buying back into equities when things were down, trying to take advantage of that volatility. Because in the end, it is all about risk management, and that's a great way to take advantage of that. The far right, you'll see the US dollar, right? So US dollar has declined about 11% year to date. We'll talk about that in the context of what the headlines mean of a weaker dollar versus a strong dollar. 2 columns to the left, you'll see cash. Cash has returned about 2% year to date. Figure cash is earning about 4% annualized yield. 5 years ago, cash was earning you 0. So cash typically is a good part of a portfolio as part of your financial planning, right? You should always have some cash there so that you don't have to worry about it, an emergency fund. But cash is not the substitute for the long-term kind of growth approach, outperforming inflation, et cetera. So next slide, please. And then, Sarah, we talk about investing at the highs or investing at the lows. Maybe I want to wait until all that volatility kind of dissipates. What are we looking at here?
Yeah, it's really interesting. So we do get that question quite a bit from clients who say, oh, we're hitting an all-time high. I'm not sure this is the best time to put money in. I want to wait for a pullback. So if you look at this graph, what you're seeing is the S&P 500 in the gold line. And the bars are showing you the number of all-time highs in that year for the S&P 500. So look at 2024. I believe that number is 57, and it hit its all-time high 57 times, and the market continued to go higher. So if you had the thought, oh, I shouldn't put any money in, we're at an all-time high, it just went higher from there. And that has been, quite the pattern through time.
Mm-hmm. And even if you go a little bit to the left there, you look at the highest number of all-time highs in 1995, as the tech kind of dot-com boom was starting in the late 1990s. You had 77 days when the market S&P 500 hit an all-time high. So there's roughly 200 or so, 220 trading days. It's like 30% of the time, right? That's a really high number. And you thought, I'm going to wait until that all-time high, until market goes down. Well, you would have missed a fair number of years. And even considering from the years 2000 to 2005, when we had the tech crash, and then 2007 to about 13, when we were really kind of still coming out of the financial crisis, markets were still there, still hanging in. This is a price only index. We'll talk about dividends and the impact of getting return from dividends, getting paid to wait through volatility. But it really takes, it can, as you wrote here, it can be very counterproductive to wait for that pullback.
And George, based on this, when would you say is the best time to invest?
Yesterday.
When's the second best time?
Today.
And the third?
Tomorrow.
All right, that's it. Yep.
Yeah. The beginning of the year last year, so many headlines, so many people were talking about the Mag 7, the biggest tech companies in the world, in the country, and maybe those are all that you want to invest in. Well, we can see what they've done year to date through June. Facebook, which is Meta, was up, Microsoft was up, Nvidia was up, but on the downside, Google and Tesla and Amazon, Apple, all down. If you take them on an equal weighted average, you're about 2%, 2.5% year to date. And what did you say, Sarah, was the year to date in the S&P? About 6?
It's yep, about 6. Actually, as of today, it's probably more like 8, but as of the end of the second quarter, it's about 6.
Yeah. So what does that mean? You've got another 493 companies
That's right.
moving along at much higher rate, right?
That's right.
So you can't just time the market, and you can't just focus on a very small sector of the market.
That's right. I mean, yes, the Mag 7 have killed it for a while, but we did see a lot of broadening out into the rest of the S&P, throughout the first half of this year, which was good to see.
And very healthy for investors in the economy, no question.
Yep. Yep.
Good. We've been talking about what's happened in the past. Markets are forward-looking mechanisms, and we want to talk about kind of what the landscape looks like going forward. And so we want to talk about growth. We want to talk about interest rates. We want to talk about inflation. One of the first things we want to show here is what gross domestic product is kind of looking like, and some expectations for this year and for next year. And on the worldwide basis, we're expecting, research is showing, roughly around 3 to 3.5% average returns this year and next year. And you can see the different countries. And Sarah, did you want to maybe point out kind of some of the differences in the countries here? Because
Right.
it's really illustrative of how we approach portfolios.
Yeah, if you're too myopically focused on just what's happening in the US, you could feel some consternation that you see the GDP growth forecast for the US is ticking down a little bit. We had a reading in May, which we talked about in our last webinar, that showed GDP decreasing a little bit, and that was primarily due to the net imports number from pulling in some imports ahead of tariff news that the companies had done. And then it looks like they are predicting a little bit lower growth in 2026. But if you look to the right, you see the euro area, 17 countries predicted to grow, Germany as well. And some mixed news for the UK, Japan, perhaps not so great. But overall for the world, it's looking pretty good, like you said. So that's why it's important to um, take a global look, to remember that that is why we incorporate more than just the US in our portfolios. And we'll talk a little bit more about that international diversification later. But a lot of what we're seeing now in the data is really reinforcing that diversification.
Solid, if not unremarkable growth, but certainly solid growth. And in Germany, Europe, the Eurozone, they're taking steps across the board to improve and stimulate the economy, improve regulations, improve corporate growth. And so, from a valuation standpoint, the Eurozone is looking strong. And from a growth standpoint, it looks like it's turning the corner where it's been relatively stagnant for a fair number of years. So good. Wage growth. Wages are all part of the inflationary market, and over time, we're about 3.3% annualized wage growth. And what are we looking at now?
Yeah, we're above that historical average, and it looks like we're at about 3.9%. It has come down from some of the peak that you see there, but this does play into the health of the consumer as well. So when we're looking at that overall, like you said, that overall inflationary picture, we're looking at GDP growth, and we know that 70% of our GDP is from the consumption. And we have seen good data on the fact that the consumers are still out there, they're still buying, they're still strong, and households still relatively low debt, historically speaking, and employment is still historically low, around 4.1 or 2%, I think.
Yeah, and I think the other thing to remember on this too, for the audience, is this is year over year change. So it's where were we last year, where are we today, and doing the average. So you can see those big spikes in 2020 and 21 because with the shutdown and with the reemergence, there were just huge dislocations in employment for a short period of time. And there were, if at one point in 21 and 22, we were looking at annualized rates of over 9% inflation. And there was a lot of consternation and worry about that. And wage growth was part of that. But we knew when you start to annualize that, it's going to start to work itself out back to that historical average. And wage growth is one of the data points the Fed looks at when they're starting to decide on whether or not they should change interest rates, moving them up or down. Good. The other part of this is where it fits into inflation. And right now, what we're looking at here on this chart with inflation, we've got a number of different pieces here, but on the far left, the consumer price index, we have core consumer price index, which pulls out energy and food, which can be volatile. But basically, what you're looking at is between 2.5% and 3% inflation on average, as our latest read. The Fed kind of looks in the middle there, the core PCE. The Fed's target is 2%. And Sarah, what's the trend here? What are we looking at?
So we see here that the CPI numbers ticked up just a little bit from the previous quarter, which I think came out at about 2.4%. But the interesting thing was this graph, I believe, was printed before we had the PPI number. PPI actually decreased in the second quarter compared to the first quarter. So that was an interesting read. Overall, it's a little sign to be paying attention to, the direction of the CPI. And this is, like you said, what the Fed is also watching to see if any of the results of increased tariffs are going to make its way through to the data. But you can see on the graph, we have peak and trough there in the blue diamond and the little X. And so we're lower than we were, but we're also higher than we were. So we're kind of in the midpoint there.
Yeah. And you also have to think about, so the consumer price index, the CPI, the PPI is the producer price index. So that's a wholesale number. So what you pay, what manufacturers and wholesaler levels are paying. It's also very survey based. So there's almost no way to get a pricing and changes across the board. So Bureau of Labor Statistics does a survey every month, and that survey changes and who answers it, and there's a data collection issue around some of this. But when we look at trends, what we're seeing is that we're seeing inflation come down, not to the levels yet that the Fed feels comfortable with for starting to cut rates, but its directionality is going in the right way. The second is the Fed recognizes that this talk of tariffs and the changes of tariffs that have happened, whether the percentages were very high in April and March, the real fear and worry versus a lot lower now, and all the negotiations going on, they don't have enough data yet, right? They've come out and they've talked about they want to be really understanding what the data is, and they need to kind of go through some more months of that. And I think the next piece here on the Fed funds and where the Fed may do their interest rate cutting and when is reflective of that deliberate approach. And Sarah, if you want to kind of walk us through what this graph is showing us, that would be great.
Right. So the blue bars are showing us how many hikes or cuts, in this case, cuts, are we projecting to have at the Fed meetings. And so you can see, looking at the dates on the bottom, that by the end of the year, they're projecting about 2, and bringing the Fed funds rate, which is in the dark blue line, down to around 3.9%, looks like. So that's currently the thinking. And you're right, the Fed is waiting for the data before they make a decision. And we had a question from a client come in, when will we know if the tariffs are going to impact inflation? And we don't know. We're waiting, we're watching, and the Fed is doing the same thing. So probably by the end of the year, you'll see it in the data, whether it's taking an effect or not.
So in the totality, what it's looking at is we're starting somewhere right around here, right today, versus where we're going to be in 18 months. The expectation or the forecasting is that the Federal Reserve will cut rates somewhere around 1 to 1.25% over the next 18 months, getting it from about 4.25 somewhere at around 3%. That should theoretically, so the Federal Reserve, just so you know, impacts short-term rates. They do not impact long-term rates in a normalized environment. The market, the bond market, and expectations for inflation and the bond market participants direct what happens on the long end of the curve. But the goal is to bring rates down somewhat over the next 12 to 18 months. And the idea being that's going to help maintain the economy on its steady pace. So not only is there a kind of a thought of what's going to happen with inflation and wanting to see what tariffs do, there is also a fear of, if you don't cut rates, that you will end up with a really slow economy or a much slower economy, and that it's walking a very fine line there. And another question that came in, what about stagflation? So you have inflation, deflation, and stagflation. It's kind of in the middle there. And unlike Goldilocks, it's not the good thing you want to have. So stagflation is kind of defining as higher inflation, low wage growth, high unemployment. It's the worst of kind of all three worlds. The reality is that and we last saw this in the 1970s. And Sarah, you and I were talking about it and why that may or may not come to fruition, and maybe add some of your thoughts in that as in here as well, because the way we're seeing it, is probably not that impactful yet.
No, I don't think that anyone is seeing it in the data. You know, when you look at the strong employment numbers, you look at the strong consumer numbers. But you're right. I mean, we did see, you know, slight projections for slower GDP growth. We don't know what is going to happen with inflation. So it is that knife's edge that they're walking on, which is why they have to be careful. You don't want to stamp out growth, but you also don't want to fan the flames of inflation. So, but I don't think you're correct. I don't think it's anywhere near the 70s, which of course I don't remember. I was far too young, but from what I've heard, it was terrible.
Well, I was. I was young, but not. I was around, and I do remember that. And the thing about the today where we are, is you think about, the economically, it's about workers and employment levels, but it's also about productivity. And
Mhm.
if you think about the economy today and where we are, it's, we've gone through at least two technological revolutions, and we might be into this third revolution with AI, and it's much, much different than the 1970s. The other part of it is where our interest rates are so much lower, inflation is so much lower, and in fact, too, we are energy independent. We are now an energy exporter versus an energy importer versus the 1970s. So to make the direct comparison of 1970s stagflation, I'm not seeing that headline come to fruition. Headlines are designed to kind of instill that anxiety and sell advertisement. I'm not seeing that, and I'm not just saying that as well. We're hearing the same thing from many of the other economists and research firms that we follow and work with. That kind of headline of stagflation just isn't there yet in the data.
Yep.
So we talked a little bit about what's gone in the past, kind of economically, where we think things are happening. How do we kind of tie it all together within the portfolio? And I think there are three things that we wanted to focus in on here today for you. The first being what's going on with the US dollar. Is it up, down, or sideways, and does it really matter? The second thing is international has had a great return year to date, has had great return over the last 12 months. And many people are starting to say, maybe I should have more or less international in my portfolio. So how much should we think about should be in the portfolio, and how do we position it? And then we always think about factors of return, evidence-based approach, things that make a long-term sustainable portfolio management. And I'm going to use portfolio with a capital P and management with a capital M, because that's really what it is, that long-term strategy approach. Some of the things are profitability, some of the things are valuation, some of the things are about size, some of the things are about geographical diversification. But another couple of factors are about quality and profitability and getting paid while you wait. And we can see that kind of built in with dividends here too. So we wanted to talk about the next couple of slides on these three topics. The first here you're going to see is on the US dollar. So the headlines are weaker dollar, dollar has gotten decreased in value. What does that actually mean? So the Federal Reserve of St. Louis has some great information and great charts. And this is a long-term chart of the US dollar index. And you can just see how much it's moved up and down over the years. And the far right is kind of where we are now. And Sarah, if you want to just talk about kind of where we are relative to where we have been.
Sure. You know, when you look at this, so you take 100 as kind of the base level. We're far above that now, and sure, we have come down, but we're still at levels that we have seen as recently as 2023 and back to 2020. And so I think that a lot of people are concerned. We get a lot of client questions because headlines are talking about a weaker dollar, and the word weak sounds bad, but what we must remember is that it's just a word to describe the movement of one currency against another. So they're comparing the movement of the dollar against a basket of other international currencies. And when other currencies are going up and the dollar is down, it's quote unquote weakening against them. But that's not necessarily a bad thing.
Mhm. And I think if I remember correctly, we had a webinar, and we talked about it. We wrote in some of our commentaries in 22 and 23 when the dollar was strong. We were telling people, go to Europe. Your dollar's going to go pretty far relative to where it had been, right?
Right. And I tell you what, it's not stopping people now from going to Europe. I mean, travel is strong. So I've heard
Mhm.
of a lot of people traveling internationally this summer, despite the fact that your dollar does not go as far. So even though it's helpful when you travel internationally with a strong dollar, it's still happening with a weak dollar.
So what are some of the factors here? If we go to the next slide, there's a few factors that kind of get involved in this. So as Sarah mentioned, the weakening dollar means its value is simply changing relative to other currencies. But it's not simply because of the headline of tariffs either. And it's not simply because of the headline of trade deficits. There's just so much that goes into it. Relative interest rates across the world, inflation across the world, trade dynamics, monetary policy, fiscal policy, it all kind of comes into play. And so stronger or weaker can depend really on, is it a benefit or a hindrance? Depends on your perspective. If you're traveling overseas, you want a stronger dollar. Your dollar is going to go further. If you are traveling, if you're outside and you now and the weaker dollar is not overseas, and the weaker dollar may not be helping you. But it also can be a real benefit for U.S. multinational companies. So if you think about companies like Coca-Cola, Pepsi, Colgate, Procter and Gamble, McDonald's, for example, they have huge international operations. And so when the dollar weakens, they have to bring their profits from overseas back into the United States. That weaker dollar actually is very beneficial. We have seen already earnings reports benefiting from those companies because of the weaker dollar. It makes their exports more competitive. Their products become cheaper for international buyers. It can improve their market share and boost their sales. And so, we call it a lesser known truth. I'd call it a dirty little secret sometimes that they don't want you to know, but they don't mind that weaker dollar. And so there are some implications. And Sarah, if you want to take the right side of this the slide and just talk about some of those implications that we're seeing.
Sure, sure. We do, like I said, we get a lot of questions. The dollar's weakening. What does that mean? What should I do? Well, listen, if you have international investments, which we all do, that's great for those. So that's going to improve the performance of your international equities because, a weaker dollar compared to their currency is helpful when it's translated back into returns. So, we don't hedge in our equity side because that can increase volatility. We would hedge on the fixed income side. I believe we may have talked about this at our last webinar. Yeah, so it helps the emerging markets, as it says here, and it's not necessarily a negative to have a weaker dollar, particularly when you are invested internationally.
And I think the key question, the key statement here too is you can't time the markets. You can't time equity markets, you can't time bond markets. It's extremely hard to try to time currency movements. And it really shouldn't dictate your short-term decisions, right? So, we do factor in currency movements, as Sarah said. The foreign bond funds that we use do hedge back to the US dollar to mute out that currency fluctuation. The mutual funds on the equity side, research shows that currency hedging on equities is not as beneficial for that. So most of the mutual funds that are out there don't do that. So what does this mean for international investments? Well, if the dollar is weakening and international equities are improving, that's kind of a correlation that is inverse, right? So one is going up, one is going down, that inverse relation. And on the left-hand side, you can see that going back to 2000. It's going back to 2000. And Sarah, if you want to talk about that, and then we'll go into the right side of the equation here.
Sure. The graph on the left is a very visually appealing because you can really see how they differ from each other. So the purple line would be the dollar index. The orange line would be the MSCI EFA, which is the index for developed international markets. And that's the return. And so as one goes up, the other goes down, then they switch directions and the opposite happens.
Mhm.
So you can just see where we are right now. We have international going up. we have the dollar going down, and then that graph on the right is just a more for the statistics folks in the room, you can see that is the graph of the correlation. So if two objects, assets, whatever you want to think of, are always going in the opposite direction from each other, they would be perfectly negatively correlated at a -1. And over on the right-hand side, where we are currently is a -7 or 0.75. So that really kind of illustrates what we've seen on the left, where they are diverging. And so they're almost at that -1 inverse correlation.
I'm having flashbacks of CFA.
Sorry.
No, but I think really what it's illustrating here is that one, international markets will move up and down. That there is the dollar is going to have an impact on international investments, no question. But it is more important to really think kind of strategically about what the international investment role plays within the portfolio. And as it happens, there was an article in the Wall Street Journal just from a couple of weeks ago. If you would like the article, just let us know, put your name in the chat. We can send that to you. But I think the question was how much of the portfolio should be in international stocks or investments. And through their survey and looking at across the board of the investment landscape, they're kind of coalescing around firms are putting in about 35% into global investments, and with a range anywhere from 20 to 45%. So we are about our U.S. allocation to international allocation is about 2/3 to 1/3. We've been plus and minus that for a long time. We might go up to 70/30. We might go down to about the 60/40. But we are always having that U.S. bias in there. If you go back to the 1980s, the United States was only 30% of the world. Japan was actually a much larger economy in terms of equity markets than the U.S. And now I think Japan is about 5%, and the U.S. is closer to 60 something. Mm-hmm. So we have been at that 2/3, 1/3. For quite some time. There's been numerous studies, research done about what's the optimal amount, and you get some diminishing returns, don't you, Sarah, when you go above that 30 to 35?
That's correct. Our own internal research paired with studies that Vanguard has done has shown that. So they look to see, once you start introducing international equities into an all U.S. equity portfolio, at what point does the diversification start to not help the return? So at what point do you see diminishing risk-adjusted returns? And it's really kind of after about that 30% mark.
Mm-hmm. Yeah. And it's not just about the amount or what the markets tell us, but it's also about valuation. So the U.S. markets are trading at about 22, 23 times earnings. International markets about 14 times earnings, a pretty wide gap relative to history. International growth is starting to accelerate a little bit. International equities actually have a higher dividend yield than U.S. equities, and you have some correlation and diversification benefits as well. So we continue to feel very comfortable having international investments both on the equity side and on the fixed income side within portfolios, and keeping it at around that 2/3, 1/3 range with some abilities to guardrail up and down from there. So that kind of brings into the last part of it here. If you could go back just one slide, please, of the impact of dividends and the factors that go into it. And again, the Wall Street Journal, I do a lot of reading. Wall Street Journal is one of my favorite reads every day. If I I'll give you one suggestion. If you have nothing else to read the headlines of the Wall Street Journal every day, read Barron's every Saturday. It's absolutely incredible, both to get an economic perspective and a world perspective of kind of just seeing what's being written about, as well as some good stories and great writing. But dividends, Payouts aren't always about income, and that's all right. So dividends matter. Dividends are part of total return. So if we think about the price plus dividend income, that gives you your total return. Reinvesting dividends, when people think about them more than just for income, but dividend stocks imply a valuation metric there with strong fundamentals and dividends. And that profitability, which is proven to be a very long-term factor of investing, really can kind of play out as one factor in there. And Sarah, I don't know if you want to add anything to this at all. So.
Right. Yeah, I think it's important to remember that there are two components to return. It's not just the price appreciation, it is also the income. And yeah, yeah, I just
Yeah,
think
if we go
that
to the next slide, I think you can see it really
yeah,
illustrated with the price versus total return.
thank you. Yes, yes.
Yeah. So
There we
what we're
go.
looking at here is the S&P 500 in price only, and the S&P 500 in total return, including dividends over the last 30 years. Okay. Would you like to start, Sarah?
Sure, thank you. Yeah, so the purple is, of course, the price return, and the orange is the total return, and you can see how much higher total return is. So what they're doing here is they are assuming that whatever dividends are paying out will be reinvested into the index, and that is what you would call total return. So there's a huge divergence here over on the right when you factor in the inclusion of dividends. Like you said, George, it's about a 2% difference.
2% annualized difference,
Right, right.
annualized over 30 years, right? So it's not just a high dividend, but it's dividend growth. And I think that the next slide shows it. So you can have a dividend. So if your dividend back in 1995, it was roughly, if we make things equalize, you got a dividend on the S&P 500 of about $17 a share, weighted average back in 1995. And if you don't sell that share today, you are getting about $77 per share. Now, companies are growing their dividends, companies are growing their profits, companies are paying out and increasing their dividends, right? So that growing dividend has a huge impact. You can see that companies are going to conserve cash in times of market downturn. You can see that kind of flattening during the tech crash. You saw a reduction in dividends during the 2008 financial crisis. You saw companies conserving cash during 2020. That's fair. There's no question on that. But the absent taxes, and even with low tax rates on dividends, qualified dividends, getting paid to wait through that volatility makes a huge difference. Absolutely. And it again is part and parcel of how we think about, how we think about strategizing within portfolios. So as we kind of wrap this up, what are the key takeaways here? And I think you have to think about time as a strategic asset in your portfolio, and think about time, and how you invest. The short term, every day, every moment, you're reading the headlines, and it kind of, it's hard to look beyond that headline. But we try to look 1 year, 5 year, 3 years, 20 years. What are the factors that really make the importance within long-term growth, allowing that compounding to happen, allowing that perspective to develop? The other part that we think about is not panicking. We know through history and through time that markets rebound. We want to rebalance when there is volatility. We want to understand that we can get income from dividends and bond interest and even cash, right, during times of volatility. So you're not forced to sell when things are down, and you want to be able to take advantage of that volatility either through tax loss harvesting, rebalancing back to target, doing Roth conversions, for example. And I think that all plays into that diversification payoff, the global performance. We can see it this year already, and you can see it even in the long term over the last 5 years and 3 years, where international and small cap have done really well relative to their history. What they're haven't done well is relative to one part of the market. But it would have been really hard for us to 5, 6 years ago to say this is the one piece. So I don't want to do that. I want to own the whole market. So that diversification, that understanding of what market impacts are like, and that time perspective really are things that we think about within the portfolio. And then when Sarah's team thinks about the next few things and how we allocate and how we structure portfolios, if you can take the last few here, Sarah.
Sure. So, in thinking about, where is the economy going? What is the Fed going to be doing? What's the dollar doing? And I see, questions coming into the chat. We've had questions coming to us prior to the webinar where people are very, very concerned about a lot of the headlines they're seeing. And I'm not saying it's not right to be concerned about these things. And could we see inflation? Sure. Are we seeing it yet? Maybe a little, but not too much yet. So when we say that economic stability holds, again, I would say that looking at the data, which is really all we can do right now, it's not really filtering through yet. This isn't to say that it won't, but right now, consumer looks strong. Like I said, employment looks strong. The Fed is also being cautious. People are concerned, I know, with headlines about what's going to happen to the Fed chair. Who knows? But I don't know that it's going to impact us in the near term here. We've talked about the dollar trends and where that's a good thing, where that's a bad thing. But then, I think it's important, George, to recognize that the market is not the economy. And that's not to say that we don't look towards the economy to see what's happening. People are oftentimes a bit taken aback by the fact that the market seems to be not incorporating some of the danger signals or some of the headlines. But we have to remember that it is a forward-looking mechanism. And a lot of times it's already baking in some of those expectations and projections. And what the market really hates more than anything is uncertainty. So it's not exactly concerned about politics as much as it's concerned about policy. So once a decision is made, I think then the market can kind of say, okay, now we know what we're dealing with, and now we can move forward.
Absolutely. And we talk about, maintaining that long-term strategy, maintaining that discipline as our best path forward. But what it doesn't mean is being not making changes, right? We have to be adaptive to what current and future markets may look like and having that flexibility going forward. And I think one of the key, we talked about this earlier, I don't think we mentioned it yet, but you look at the iPhone. The iPhone is only 18 years, roughly 18 years in existence. I mean, it's barely an adult, right? Think about 18 years ago. No one was really talking about what the iPhone could do for you. Where are we going to be 18 years from now, right? That's what we need to be thinking about. And so those are our takeaways. I know we have some questions, and we do have a couple of questions that we pre-prepared here because it is in the headlines too. And I want to address one of them. We've addressed tariffs, we've addressed interest rates, we've addressed the dollar, but another big one that's out there is on private investments. And this is kind of the next step of being adaptive. Private investments are in the headlines quite a bit. We've seen tremendous growth in private investments. At Modera, we have been doing and investing in private investments for more than 15 years, we're actually closer to 20 years in different various forms. There are changes happening in the investment landscape with private investments. More companies are staying private for longer, and more companies are not going public. So there's been a big drop in the number of publicly traded companies, and more companies are staying private longer. And so that combined with changes technologically to allow private investments to be broadened out for a broader audience have really made more availability, right? And you can see this graph showing kind of what the trends are and new features and investment types. And we think about it in 4 different factors for us: private credit, private equity, infrastructure, and real estate. If you go to the next slide, please. And how we think about it is really in that, again, that evidence-based approach. What is the goal you're trying to achieve? Tom's got a great way of it. thinking about it, Sarah.
Right. Yes. As far as what is the problem you're trying to solve.
Yeah, what's the problem you're trying to solve? Absolutely.
Yep. It's going to be different for every investor too.
Mhm.
So, for some people, they are looking for a little bit extra return. For some
Mhm.
others, they might be looking for income. I think for everybody, improved diversification, lower correlation is a positive, and it allows you to play in a larger sandbox. Because as you were saying, there are so many more private opportunities necessarily than public. At least it's definitely changed over time.
Absolutely. And these are the ideas behind, just a few of the ideas behind private investments. Not all of them are going to apply to every single asset class or type of investment. And we illustrate that on the next slide. If you're looking for more capital appreciation, maybe you think about private equity or private real estate. If you're thinking about income, maybe private credit can fill the bill there, right? Inflation protection with real estate and infrastructure as well. And there can be tax advantages depending on the type of private investment and the type of vehicle you use. So we've been doing a lot of research on private investments and a lot of, some of you as clients already own some private investments, and we're expanding that out, and there'll be more to come and more to hear from on this. But I do want to emphasize, and we'll illustrate it on the next slide here, everything we do within private investments has to fit the core fundamentals of our strategy and our approach. It is that disciplined, evidence-based, long-term approach. Are they investments that we understand, that we have access to the managers, that they're experienced managers, fees can be reasonable? Do they fit in to the allocation? How do they fit in? And as Sarah pointed out, private investments aren't for everyone, nor should they be. And not every private investment should be in the mix for every client. But if we can help understand what the goals are from a planning side and what the opportunity set is on the investment side, then we can help you figure out what that investment mix may or may not look like for you. And so again, if we think about whether it's income and diversification, whether it's inflation protection, whether it's enhanced return, maybe it's risk reduction, there are a number of different ways to think about it, but it really goes to the core fundamentals of how we think about portfolios, which is evidence-based, long-term, globally diversified, understandable, and risk managed approach to investing for you and your goals. It all has to make sense. Positives and negatives. And again, I'm not going to go through all of these. We're towards the end here, and I know there's some other questions that we want to get to, and I want to be cognizant of time here as well. But and we are going to send all this data out to you. If you do have questions on private investments or anything we've talked about, certainly talk to your advisor, your wealth manager. We have all of our disclosures here. I know we've got another webinar coming up in October, I think it is. So I hope you
Yes.
join us for that third webinar. And then we have another one in January. Yep, Thursday, October 23rd, we'll be doing this again. I want to thank you for your time. I don't think we've addressed most of the questions. I don't think that there are others here. Sarah, this has been, you and I talk all the time, but I want to say this is always a great opportunity for us to really understand and think about how we approach things for clients. So I just want to thank you for all that you're doing on behalf of our clients and
I
your team.
agree. Thank you, George. It's a pleasure to do this. I find this work very, very interesting, and I love talking to people about it. So
Great.
happy to do it.
Everyone, thank you so much for your time. We really appreciate everyone sticking around for us on a summer day, and we hope you have a great rest of your summer. And we'll see you in the fall. And as always, if you have questions, feel free to reach out to us directly or via your wealth manager and advisor. Thanks so much.